It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome. It is the Jill on Money show. This is the program where we take the mystery out of your finances. I am Jill Schlesinger. I am joined by Mark Talercio, who's running my show, my life, and everything. And we are here to try to figure out how you can really get through this uncertain period with a little grace, with a little dignity, and with hopefully a little more money. If you've got a question, we'd love to hear from you. Our email address is askjill@jillonmoney.com. And of course, we want to remind you that we are broadcasting from the Capital One Bank virtual studios. Capital One, what's in your wallet? Well, Mark, it's the end of June. I can't believe it. It's so strange. This is going to be some weirdo summer, but we will continue to proceed. We will just keep rocking and rolling, do the best we can. And of course, with your help, because without your questions, this show really would not be able to survive. So we want to thank everyone in advance who sends us email. We are trying to plow through our responses and get as many people on the air as possible. So we understand that. So just really be a little patient if we don't get back to you immediately. Okay. This is from John and Julie, really from John. So John writes, my wife and I are longtime listeners of the show. Thanks so much for your daily insight and advice. Every time we listen, we're learning something new. Thanks for taking the time to read and respond to our question. Work moved me overseas just before all this craziness started, and we were lucky because our house sold fast. Wow. We now have the proceeds from the sale. It's just under $100,000, and we would like to invest it. Work covers our housing expenses overseas, so we don't immediately need the funds. We expect we will need these funds in the next 3 to 5 years when we return to the U.S. So that would be the down payment in the purchase of the next home. We are thinking either exchange-traded funds or laddered CDs. How would you recommend that we invest it? Are there other options we should be considering? Here's the background. John's 35, his wife is 37. No children, but they're planning on having a few within the next few years. I work. My wife stopped last year as we prepared to move. She is not working overseas. We're maxing my 401k and Roth IRA. Gross income, $110,000. Monthly expenses, wow, roughly $500. That's really tiny. Okay, emergency savings, $90,000. 401k, which is both a Roth and a traditional, $225,000. Roth IRA, $160,000. Brokerage account, $150,000. Thanks for taking the time to respond. So obviously, I'm not sure if the 100,000 is already included in that brokerage account or not. It's probably not, but let's just presume that it's sitting outside somewhere else. I would take the 100,000 and I would put it into that brokerage account. And now I would look at a portfolio for that account that has a much lower risk level overall. You didn't mention where you might move back to, how much money you might need for a housing cost, and obviously all of your expenses would go up when you returned. But I think that if you have a combination of what you're suggesting. So, I mean, again, it's 3 years is enough time where you can have what I would call a conservative growth portfolio, where you would have some of the money that is invested in stocks and some in bonds and CDs. And whatever amount you think you really could need in the next 3 years, I wouldn't really have much more than, say, 30% in stocks, maybe 35%. And the problem with the laddered CDs, of course, is that interest rates are really low, but it's a pretty simple methodology to get you where you want to go. And maybe what you do is you ladder those CDs with slightly longer maturities so you get better interest. I wouldn't be afraid, though, of having a bond fund. It's not the worst idea in the world. And I think that if you kind of keep it easy on the risk, you should be just fine. Just fine. It's just one of those things where you also have to be comfortable with what you choose. because part of this is going to be about your ability to weather ups and downs. Okay. All right, next question is from Dorian. Hey, Aunt Jill, I have been a fan of yours since I was introduced to you as a regular guest on the 404. That was a podcast from CNET, and gosh, I loved that show. And Dorian says, I miss those boys so much. Me too. You got me interested in learning more about personal finance and changed my financial outlook. My question is, would you recommend building up your house fund in a brokerage account using exchange traded funds if you plan on buying a house in 2 to 3 years? So, this is very much like the previous question. So, here, Dorian says, I'm currently splitting my savings contributions between a safe savings account and exchange traded funds in a brokerage account. I know I should have safe money in a savings account, but I don't want to miss out on the upside of having some of that money invested for 2 to 3 years. So, what do you think? Happy Pride. Thanks, Aunt Jill. Well, you know what, Dorian? Here's what I do think. Like I said in the previous response, I think that you can have some of the upside. I think with 2 to 3 years, I probably would change the allocation and tilt it more towards boring and safe than upside. Because, you say 2 years, but if in 18 months, if something came along that looked fantastic, would you actually want to jump on that? I think you would. I do. And I think that it would be important for you to try to determine, just how quickly this money is going to be needed. And then we can allocate accordingly. I also presume that you're working and maybe you've got other money invested that helps you capture that upside, probably in a retirement account, right? So I wouldn't go crazy. The one thing I always try to caution people about is that if you understand that you will need this money in 2 to 3 years, and we are talking about housing, sometimes things come up sooner than that. And if you want the ability to be able to pounce on that opportunity, I would suggest to you that you should absolutely, positively go in the direction of taking on less risk. Okay. Hey, Mark, I got a question from my friend's 16-year-old son. And the question is, I want to start investing. I'm 16 years old. What would you suggest? How would you like to direct my friend's son, Sammy, in his first investing? Where do you want to go with this, Mark? So Mark says, these kids, they all love Robinhood these days. I'm sure you guys are all reading about Robinhood. That is the app where it's very seamless to use it, and it's an easy way to invest. And I certainly think it's great. But the amount of speculation that has been going on with Robinhood does cause me some concern. There are also, you also have the ability to buy fractional shares of companies through Schwab. They have a new program. And then there's the good old boring index fund world. And God knows that there is nothing wrong with buying a Vanguard index fund, a Schwab index fund, a T. Rowe Price, a TD Ameritrade, a Fidelity. So when we return, we're going to answer more of your questions. During the break, why don't you subscribe to our sister podcast? It is called Jill on Money. You can get it on Apple, Stitcher, Spotify, radio.com, Google Play, or wherever you find your favorite podcast. We'll be right back.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
You're back. It's Jill on Money. And this is the program that takes the mystery out of your financial life. And it's the last weekend of June. I cannot believe it. Time seems to be passing by very quickly in some respects, and the days go very slowly. I don't know if you guys are finding that. That's what we're finding over here in Jill on Money land. Okay, so let's do this. Let's get to some more questions, because that's why those emails are piling up, because I need to get to these questions a little bit more efficiently and quickly. Okay. Here is Diane. Not sure how much info would be helpful, but here are some of the gory details. Okay, I moved about $300,000 to a mutual fund called the Vanguard Managed Allocation Fund. The idea was to generate an income stream of $1,000 each month. Okay, so here's the issue. This fund used to give monthly payouts of about 4%. I guess 4% would be annualized. They've now decided to distribute annually. Okay, so here's the deal. The fund cost 0.32%, and that seemed worth it to me to simplify my monthly money management. But annual payments, I can handle myself. Okay, now, here's the deal. I wanted this to be relatively reliable income. I don't want to go with just an S&P 500 fund and hope for the best. Okay, so here's what Diane did. She looked at lower cost conservative funds. The first is called the Fidelity Freedom 2015 Fund. Okay, Fidelity Freedom, these funds are essentially target date funds. They call them freedom funds. And in this one, if you look at the 2015 fund, obviously, if you were somebody who had um, retired in 2015, you would want an allocation that helped generate some money. So in this fund, there is about let's call it 28% in US stocks, about 17% in international stocks, bonds are 40, and short-term debt is about 13. So it is essentially like 55% safe stuff, 45% risky stuff. Okay, so that's a possibility. The other possibility is a fund that is a Vanguard fund, another Vanguard fund, and this is called the Life Strategy Income Fund. So the Vanguard Life Strategy Fund, it's considered a conservative allocation. It holds 80% of its assets in bonds, okay, and 20% in stocks. So this would be a lower risk option for Diane than the Fidelity Freedom Fund. Okay, so here's more about Diane. I'm going to turn 60 later this year. I retired somewhat unexpectedly last year to provide 24/7 care for a dear friend undergoing surgery and treatments for late stage ovarian cancer. Thankfully, the cancer is in remission now. With things as they are, I thought I'd stay retired, but I could work again if necessary. I was most recently an IT help desk staffer. I also have a degree in and love libraries, so could always work in some capacity at a library. I had 1 year's worth of expenses, $36,000, and about $1.2 million in retirement accounts. The retirement accounts included a 3% fixed annuity from the principal, 100, which was worth $102,000, and a rollover IRA, 300,000 from a pension buyout. Not a good deal, but the company was likely to be purchased by a foreign company, possibly partly for its pension assets, so seemed better than doing nothing. Okay, I've used various retirement calculators to generate a plan, and the models seem to indicate it would be wise to defer my Social Security until 70. I have a small monthly pension, and much of this goes towards medical, dental, vision. Let's see. And the annuity pays me $1,000 a month until I'm 70. And then it was supposed that this other 300,000 was supposed to be the third leg, right, of the monthly income. So here we go. I can't believe I read this whole thing and I'm going to give this advice. And I'm sorry for everyone listening. Let's take big picture. So big picture is she's 60 years old. She's got a bunch of money, about, let's call it $1.2 million. And that's in retirement accounts. And she's got some money set aside. She has some monthly income. And you know what I'm going to say? With all of this, and before you start moving stuff around and pulling money out, guess what, Diane? I think you should try to work part time. I think you should try to work to create that $1,000 a month that you are seeking from your investments. I wouldn't do that. What I would do is I would work, maybe I would work part time. It doesn't have to be full time, but I think your goal is that you should create the $1,000 a month that you need in income. I even think you might be happier if you could do a little bit more. Could you get $2,000 a month in income? And then then when you hit 65 and you get your Medicare, then your cost for your insurance that you're paying for out of pocket would be reduced. And then we are kind of smooth sailing to age 70. I'm not so sure that using this money right now is in your best interest. One of the things that becomes very difficult as you go into retirement is pulling money out of accounts and then never really getting to replenish them. So, if in this moment, instead of pulling money out, you just let this money grow for 5 years. And again, I'm not saying you've got to kill yourself and work really hard, but could you work part time? Could you get a job, as an IT help desk worker for some, you know, group of years here where you're not going to kill yourself, you're going to do it. Or maybe you even would say that you could work in a library part time, whatever it is that you think you could do. I would hesitate to use the money that you've worked hard to save and start draining the money out of that account right now. I think it makes more sense to wait until age 65. Now, if that seems onerous and awful to you, I get it. But it would seem to me that right now, an IT help desk person is somebody who could be in pretty major league demand. I remember when we interviewed uh, uh, Dan Roth from LinkedIn, that was one of the jobs that he said was in high demand. So I think that's my game plan for you. I don't want you to use this money right now. It isn't too much detail. In fact, it was perfect amount of detail. And I would feel really much more secure on your behalf if you had this nice chunk of money that was set aside and you didn't really have to worry about much more. Okay? So I hope that helps. It's always dicey when you're telling someone to keep working. Okay. During the break, go to our website. It's called jillonmoney.com. And there, sign up for our free weekly newsletter. It's free and it comes out every Friday, and Mark curates it, all good stuff. Some of it is the stuff that we've created, some of it is other folks. So give us a try there. Try that. Sign up for that free weekly newsletter. And if you've got a question and you're on our website, just click the contact button. It's in the upper right-hand corner, easy to use, and we will be able to get that email and answer it hopefully in a decent amount of time, not too much time that goes by. Okay, when we return, we will answer more of your questions. We'll be right back.
Welcome back to Jill on Money, where Jill Schlesinger takes the mystery out of your finances.
You're back. It's Jill on Money. If you have a financial question, maybe it's a big picture question, maybe it's about the economy, maybe it's about taxes, tax planning coming up. Oh my God. Maybe it's about the stock market. I mean, the NASDAQ hit a record high this past week. I mean, it doesn't make me excited. I just have to say that. Maybe you're looking for a house. We did get some data out about the housing market. We got pretty rotten numbers for existing home sales for the month of May, but that probably, my guess, is the bottom because I don't know. I think that, when you have existing home sales, it reflects the contracts that were signed. That meant deals that were done in March and April. So obviously, May was going to be a terrible month. And when you look at how the building permits, those permits actually are up, and I think that kind of generally speaking, people who are looking for homes, I do believe that you're likely to see that the market was kind of bottoming out. And I think that going forward, there are some really fascinating places where there are different trends. But I don't know, maybe potentially the suburbs are going to be hot again. Maybe people really going to spend more time in bigger homes. I don't know. But all that being said, it's been a time where people got really freaked out about the housing market. And then when you really take a close look, you say, well, interest rates are still pretty low. People still want to live somewhere. Where they live is going to be really interesting. We'll have to see. Anyway, if you have a question, send us an email, askjill@jillonmoney.com. That's what Susan did. She writes, I am a happy, healthy, married 62-year-old. My husband is 68, fairly healthy, managing high blood pressure with meds. We're ready to downsize. Here we go. Here's a real estate question. We live in a 4,100 square foot home. Wow. It was built in 1837, multiple gardens, a side yard, a built-in pool, a 1,200 square foot deck, tiki bar. I don't know. I want to come party with you guys. Socially distant, of course. Anyway, Susan says it's a lot of maintenance and we do it all ourselves. My income is $20,000. I work as a nurse's aide at a local middle school. I can ride my bike to work. My husband is retired from a city job and collects a pension of approximately 120 grand a year. Wow. With a 2% increase annually. He works part-time at a wine shop. I'm hopeful for that discount, right? Okay. From my career job, I began a 401k, and I currently have about $120,000 in stocks, mostly this one company that's a medical engineering business. I've got some pharma, gold, auto, retail, everything was with TD Ameritrade. Then $90,000 with Vanguard, money markets, and Fidelity, about 5 grand money markets and 20 grand in savings. So Susan's going to collect $1,900 a month in Social Security when she turns 65. Her husband's not eligible for Social Security. Retirement from school job, just $200 a month. So she's going to have, let's just do that quickly. So she's going to have $2,100 a month, and he has 120 grand a year in pension. Okay, I'm just writing that down. They purchased the home in 2006 for $290,000. They hope to sell it not next year, but in 2022 for $450,000. We refinanced this month. The home was appraised for $480,000. We've put about $100,000 into renovation and improvements. We owe about $250 grand after the refi. We bought both cars that we drive with cash. Credit card debt is about $5 grand. Thinking about moving from this huge house back to where we started, looking at condos, blah, blah, blah. Okay, condo price. This is not a real downsize because the condo that she says, let's say they sell their house for $450. She wants to downsize. She's going to a condo for $500 grand. That's hysterical. We love the opera, the symphony, dining, theater. We have extensive book and art record collection we want to take with us. We need this 2 to 3 bedroom condo. Should we buy or rent? Our adult children may move to the same area in the future. They may want to purchase the condo from us in 10 to 15 years, or we'll see to them in our will. Thank you for your help. Okay. First of all, one thing you didn't really mention is how much money you need. Because, presuming that you can live on your husband's pension of 120 grand a year, plus it'll be another, let's say 25 grand. So about 145,000 when you start collecting Social Security, then this is all fine. What I would say is this. I always think that we don't know what's going to happen in 2022, but my game plan for you would be that you would sell your house. Let's see where rates are. Let's see what's going on. Let's see what the market's like at that time. Maybe when we look at the condo prices, they will be way more expensive than renting, or conversely, the other way around. We don't know. But my inclination is you would rent for a year to make sure you know where you want to be, etc. I think when contemplating a downsize or a move or a change, I think it's nice to actually rent for a year and try it out, because maybe you're going to hate it. Maybe it's going to be not what you thought. It doesn't sound like it to me because you know the area, but on the other hand, if the market has tanked and interest rates are still low and it makes sense to buy, then fine. I just think it's hard to really plan 2 years in advance for this. But in general, what I would say is rent versus buy is always a fascinating conversation. We have to see what the market looks like at that time. You'll know more as you approach this period. And I wouldn't think about it for your kids as much as just for you. Of course, with condos, I always want to remind people to watch for those condo fees. They can be brutal. But it sounds like you're in good shape. It's nice to have a pension that's just there for you, isn't it? That's a good thing. A really good thing. Okay. Jill on Money. We will be right back. When we return, we're going to get back to your questions. During the break, why don't you go to the website? You can read all the stuff that we have written, maybe even listen to some past shows. The website is jillonmoney.com. We'll be right back.
If you've missed any part of a show or want to check out a past show, go to jillonmoney.com for more great personal finance content.
You're back. It's Jill on Money. This is the program that takes the mystery out of your financial life. I mean, it's kind of a smattering of anything that's going on in your financial life. Truly, it's not like one thing versus another. It's everything. Anything with a dollar sign, as I like to say. So if you have a financial question, why don't you send us an email? It's so easy. Ask Jill at jillonmoney.com. Ask Jill at jillonmoney.com. Who's getting sick of Zoom meetings? I am. I feel like the phone is just fine. Maybe it's because you guys have trained me so well that I don't see you. And it's so nice that all I have to do is concentrate on you and listen to your voice and focus 100% on your questions. That's why I love what I do, because I get to help you guys out. All right. Rochelle writes, just to let you know, you have gone international. I first heard Jill on her Here and Now segments. Okay, Here and Now, gang, is an NPR radio show, and it's hosted by my pal, Jeremy Hobson. He's one of the three hosts. And so after hearing me on Here and Now, Rochelle went right over to the podcast. I know that half the things that you talk about don't relate to me, as I'm from the UK, but I love your energy and no nonsense take on finances. It helps keep me motivated. Yes. Hey, listen, Rochelle, you might like to know that Mark lived in London for how long was that, Mark? A year? Yeah, just under a year. Mark lived there. My partner was there for 7 months. So I went back and forth for 7 months. So we just totally love the whole British culture. So now that you know that, we're all in. Rochelle's 38 years old, single. COVID came just when I was putting myself back out there. Oh, that's tough. No children, and I currently rent. I take home £2,000 a month. That's due to a 10% cut from COVID. I pay 6% pre-tax to a workplace pension scheme, which my company matches. £830 goes to rent and utilities. £270 goes to car payments and car insurance. £100 goes to Vanguard stocks and shares, And I live pretty frugally. I have about 650 pounds left over that goes into savings. It always surprises me how much some Americans are able to save each month. Even though I get paid 31,500 pounds above the UK average. My question, which is hopefully universal on both sides of the pond. I'm currently saving for a house deposit with a goal of 15,000 pounds. It's about 10% of the amount I can borrow. I have 4 years left on a car loan. It's the only debt I have. It's 8.5 thousand pounds. Oh my God. Hold on a second. It's 8,500 pounds at 17.8% interest. I'm conflicted about whether to overpay my car loan and reduce year's interest or put money into savings for the house deposit. This time last year, I had 2,000 pounds overdraft, which I had lived in for the best part of 10 years. So I am surprised and proud at the way I have rebuilt my relationship with money. I currently have 2,300 pounds in savings, which I see as an emergency fund, house deposit fund. What do you suggest? I'm working from home currently. I listen to your sage advice and snazzy theme tune, which helps stop the madness of, well, the world, even if it's just for 12 minutes. Thanks for your time and your consideration. Okay, I know you want a new house. I know you want to build a house fund, but that near 18% interest rate is something that is it's too much. It's just too much for me to say, "Oh, no, you could do both. You could do this." No, absolutely not. So, what I would say is that extra 650 pounds every single month, that goes into the car. By the way, everyone who's listening, that's about 815 bucks, okay? That goes to paying down the car loan because that loan is just too high of an interest rate. When your salary returns back to that pre-COVID level where you get that 10% back, then what I would do is I would put even more down on the car loan because from my viewpoint over here on this side of the pond, that 18%, it's pernicious, it's awful, and we want that gone. As soon as you have whittled that down, gotten rid of it, maybe you even get a bonus or something good happens, you just accelerate it, then you go 100% into home down payment fund. I think that if you were to do that, you would be much better off. And, the real estate market's going to move around a lot. I don't know what's happening where you live, but you probably don't live in a city because you have a car. But if you can somehow get that loan paid off and then redirect all the available cash to the home down payment fund, that would be great. So that said, Mark, what would you like to say as your Britishism to Rochelle before I sign off with her? Tally ho, cheerio. Mark says cheerio. I say tally ho, and we are so grateful that you listen to us. So thank you so much, and follow up with something very British. Send us a very British photo so we can ogle and miss our friends on that side. Thanks for writing. Okay, if you have a financial question, whether you are UK based, maybe she's Scottish for all I know. That would be awesome. I loved Scotland. If you've got a question wherever you live, just send us an email. Ask Jill at jillonmoney.com. Ask Jill at jillonmoney.com. We'll be right back. You're back. It's Jill on Money. We are broadcasting from the Capital One Bank virtual studios. Capital One, what's in your wallet? How about that? Before we end the first hour, I think we've got time for one more question here. This is from Shirley. who says, I appreciate your advice. Concerning emergency funds, would you suggest that each spouse have a separate emergency fund? I know there's a story behind this, and here it is. My first husband drained all of our money from our accounts before he left, and he was able to do so because every account was jointly owned. Wow. I was very young and never considered this possibility. I eventually got some of our money back. It took years of legal effort and expense. By then, my credit was ruined. I couldn't even afford a security deposit for an apartment. If I had kept an emergency fund in my name only, I could have navigated a very emotional time more successfully. So, my question, should spouses have separate emergency funds? How should they be set up, discussed, and should the details of their existence be fully shared? Thanks, Shirley. Well, let me go to the end of that first. Yes, you should have a conversation and you should share your concerns. That's number one. It's not a bad idea, but I also don't want to poo poo the idea that for many couples, just having a joint account is fine. This is really about what works best for you. And I know it's very hard once you've gone through an experience like this, which is why with a second marriage, I often will say that maybe keep some of your money separate. I don't think there's a blanket response for this, but in the words of the great Susan Schlesinger, also known as my mother, she always liked to say, what's mine is mine and what's his is ours. So that's a nice way of saying it's never a bad idea to have a little money on the side for yourself, and it should be fully disclosed. I hope that helps. Okay. Yeah, that's a tough one. I know. Okay, next hour, we've got a nice interview with my friend Mark Spindel. He's going to tell us a little bit about what's going on in the economy and with the Federal Reserve and what we might expect going forward from these crazy pandemic lockdowns. Okay, it's Jill on Money. We'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Well, it's hour number 2 of Jill on Money, and we are broadcasting from the Policy Genius Virtual Studios. Policy Genius is the easy way to compare and buy insurance. All you have to do, go to policygenius.com. All right. We have a special guest for you. This special guest, of course, happens to be one of my dearest friends, actually my oldest friend from high school. His name is Mark Spindel, but he's also co-written a book. It's called The Myth of Independence: How Congress Governs the Federal Reserve. So he is indeed a Federal Reserve expert. And I love to have Mark on because I will often call him when I can't make sense of markets and what's going on and what's happening in the universe. He's one of my go-to guys. He's sort of on my my board of directors when it comes to macroeconomic factors. So what I am trying to glean as I go through these times and even talk to you, and I'm sure you're trying to figure this out as well, is where are we in this economic cycle? What is happening here? How can we make sense of the stock market versus the real economy? And what should we expect going forward? That's what we're going to talk about with Mark Spindel. And if you have any questions after this, of course, I know you will. Just send us an email, askjill@jillonmoney.com. Here's the first part of our interview with Mark Spindel. I am bringing Mark back on the show because I adore him and I talk to him constantly about what's going on in the world. And I figured it was nicer of me to share his wisdom with you directly rather than spout off what he says in a way that's not as smart as he is. So, Mark, here we are. It's June. It is now basically 100 days since most of the country went on lockdown. Can you describe how you see the economy, big picture right now?
So we've clearly been in a huge hole, a somewhat self-induced medical coma, the need to self-quarantine, to socially distance, to really shut down an entire range of non-essential workers, sent the economy into a very deep tailspin. A sharp rise in unemployment, the likes of which none of us have ever seen, a huge collapse in gross domestic product, the output. Again, I think the thing to keep in mind is that we clearly had to prioritize health policy over any kind of economic policy. That being said, just last week, we saw a somewhat shocking rise in the labor markets. No one had suspected that we'd see that uptick in May, which suggests to me that the hole is slightly shallower than we first thought.
So what do you think has happened to make this perhaps a shallower hole than anticipated?
So I think one thing is we've managed to get our heads somewhat around social distancing and figuring out ways to work. Construction, for example, is an area where people can work outside. I think the news, the science stories on COVID have been really hard for most people to get their heads around. Obviously a lot of fear at first, a lot of worry about surface transmission. That seems to be a little less aggressive than we thought. Wearing masks, it turns out, can reduce the transmission rate significantly. So in the service sector, it turns out that the hospitality industry was one of the, if not the largest employer. Upwards of 15 million people employed in restaurants, food away from home, travel, and hotel sector. Clearly, that took a big hit. We've been able to deploy some technology to get restaurants in a sort of takeout mode. And just recently, as cities have begun to move into a phase one reopening, there's even some ability to start to think about eating out with tables, hopefully safely spread apart. That caps, the level at which the restaurant sector can return, but it changes the direction from laying people off or furloughing staff to bringing some of those back. Separately, we've seen the delivery business. I think certain pizza delivery chains have seen their best weeks and months ever. So you've seen some same-store sales activity in the traditional delivery sector really shooting the lights out. And I think the triage that some sectors, particularly tech, and firms that can avail themselves of technology have actually been doing quite well.
So that is all good, and the pickup is good. But this does not actually mean that the 20 million people or so that are sidelined, it doesn't mean that they're all coming back. So we're sort of saying, okay, there are these some sectors that are doing better than others. And if you had to ballpark it at this point, what do you think the second quarter GDP is going to drop by? How much? Give us a guesstimate.
A hard dart to throw, and I've said to someone that the range on my forecast might be almost as large as the forecast itself. But let's say the second quarter declines at a 40% annualized rate.
And so that's April, May, June, a contraction of about 40% on an annualized basis. Okay, so now let's talk about the second half of the year. As we look at the second half of the year ahead of us, obviously that's kind of where investors are looking at, second half and next year, they're all in the future. But I want to stay on the economy for a second. If you look at many of the sort of big economists who are looking out there, let's say even the National Association for Business Economics or even the CBO, they're all saying that essentially that the total value of the U.S. economy, goods and services, will fall by, let's call it 5.5% to 6% or 5 to 6%. Is that a pretty fair estimate for 2020, you think?
Yeah, I think, again, this huge hit that we're going to take in the second quarter will see some rebound into the second half, which you're focusing on. I don't think we've got enough momentum or runway in 2020 to undo this ditch that we've dug for ourselves. I think another way to think about the health of the economy, and maybe one that I think matters to listeners, to investors, to the country, is the level of unemployment. GDP has some sort of intricacies, complexities, but people know whether they're working or not. That loss of 25 million jobs from one of the strongest labor markets in not just our lifetimes, but any lifetimes up until February, reversed itself pretty sharply. And when I said that the ditch might be a little bit shallower, the hole not as deep as we thought, we still have a very long way to go. So one number that I tend to focus on is an expectation for where the unemployment rate will be at Christmas this year. We got to sub 4% in February, and by Christmas of this year, we may only get to 10 or 9%. That is an awful lot of individuals who still aren't working, a sign that the economy has not nearly recovered.
We'll get back to our interview with Mark Spindel in just a minute. Hey, during the break, here's an idea. Go to the website, jillonmoney.com. And while you're there, you can check out all the cool stuff that we have written and produced in terms of other audio stuff, and you can watch TV segments. jillonmoney.com, that's the name of the website. We'll be right back.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
You're back. It's Jill on Money. And here's a really interesting question that I keep asking myself about what's going on in the economy. We get all the data about weekly jobless claims. We get monthly jobs reports. And some of this is trying to capture a moment in time. But one of the things that I've been wondering is, how many of these furloughs or these temporary layoffs, how many of these jobs will vanish? I don't know. But what's interesting is that some portion of them will, but maybe other jobs will be created and it won't matter. Well, luckily for you, I have a guest who's going to help me answer this question. His name is Mark Spindel, and he has done a lot of thinking around long-term trends. He is an investment manager at Potomac River Capital. He's also one of my closest friends in the world. We grew up together and went to high school together. All right, here's more of our interview with Mark Spindel. I guess I'm also wondering, do you also see there, like I think there was from the University of Chicago, some idea that many of these layoffs, which we thought were temporary, will be permanent simply because the nature of how some industries operate is going to change? How do you see that playing out?
Absolutely. So, I don't think we've got a chance of getting back to 3.5% unemployment for many, many quarters. As we said, just the service sector, food away from home, the restaurant, hospitality industry, they just will sort of unlikely be allowed to go back to full strength.
If we are never going to get back to full strength,
at least not in the sort of foreseeable investable future.
Okay. So now tell us why the stock market has just gone completely ballistic to the upside. What explains that with all the caveats you're giving us? Because you're saying, okay, the hole may be shallower, maybe social distancing is working in certain areas, but that unemployment is probably still going to be 9 or 10%, that a lot of these jobs are vanishing for good, that the economy is going to be smaller at the end of this year than the beginning of this year by 5 or 6%. What's up with the stock market? Explain it to us.
By the middle to end of March, we saw a particularly strong set of tools deployed by the Federal Reserve. They let loose a very strong arsenal, essentially offering free money, free loans to a whole range of borrowers. That was a powerful stimulus in the global financial crisis a decade ago, and I think tools were rolled out very quickly in March to essentially tell investors, tell savers, tell economic agents that the Fed has their back. Coupled with a series of fiscal policies rolled out by Congress including some payroll protection, a fair amount of other government stimulus. But I think that 1-2 punch of monetary and fiscal policy essentially said to people by the end of March that the government was engaged. Are they engaged enough? Is it going to happen quickly enough? Too soon to tell, even now 3 months into it. But I think investors by the end of March were just worried that maybe we were going to sink into a multi-year, even deeper hole. And I think the payroll report last week suggested, as we've said, that most economists' consensus forecast was for another loss of jobs, significant 7.5 million jobs expected to be lost, and we gained almost 3 million jobs. So from what we expected to the jobs produced, that's a 10 million job difference. So strong monetary policy, some initial and continuing fiscal policy. Congress is debating perhaps another $1 trillion package. So a range of tools from Washington. Again, I don't think are working fast enough to get us back to the strong economy that we saw at the end of last year through February, but certainly better than investors have expected. Second thing, strong growth in the technology sector. So again, sort of firms that were winners or could use the environment to their advantage, really powering the market forward. I think investors have looked at 2020 trying to give themselves a pass on that with the expectation that 2021 is going to get them back onto a pretty solid earnings trend. They've discounted maybe the best possible outcome, particularly in the tech sector. I also think the financial sector, which has been the primary beneficiary of the free money from the Federal Reserve, the very low interest rates, they've found ways to lend that to high-grade borrowers, to high-yield borrowers, those investment-grade and high-yield sectors, absolutely supported by additional policy tools of the Federal Reserve. It feels to me like we've stretched ourselves pretty thin in terms of the new expectations. And I would bring it back to the economy, that to the extent we think the labor market is still going to be suffering by Christmas of this year, the hole might be shallower. We might be getting ourselves out of it quicker than we thought, but we still have a very long way to go.
That's at least like a more measured approach to, everybody saying mission accomplished, we're back at work, everyone's rocking and rolling. I also am interested to see how different parts of the economy start reacting next year, because we had a whole host of companies that said, oh, no, we're not laying anyone off this year, 2020, blah, blah, blah. Next year, I don't know. I feel like there could be a whole wave of layoffs in more of like the white collar layoffs, like, okay, everyone worked from home, that's fine. But now we figured out we don't need everybody. What do you think?
First of all, keep in mind that the payroll protection plan, which Congress rolled out, really compelled firms to try to keep staff on board. That could run out by the end of the summer. So this isn't even a 2021 story. To your broader point, yes, I think have firms or will firms realize that we talked about restaurants, we talked about the hospitality sector, perhaps airplanes are going to operate at new lower capacity levels. Will firms that have typically packed labor in, will technology take off? I think these are all risks. Now, will the entrepreneurial and animal spirits find ways for the labor market to clear? Sure. Will prices adjust in that process? If we can think back to our undergrad microeconomics, absolutely. But that takes time. And the displacement is hard. The transition from not so much an old economy, but to a new economy, I think will take some time to put in place. And that's not a 2020, that might not even be a 2021 story.
Interest rates are at zero. So here's the question that I have for you. How would you rate the Fed's performance during the pandemic?
So I would give them maybe a solid gentleman's B. And I think they have rolled out a set of policies quickly. They have responded in ways that Congress designed. But I worry that we may be, or we should be thinking about costs and consequences to a Fed that has completely intermediated the market for credit.
Explain that sentence. The Fed that has intermediated credit. Explain what that means to regular people.
So the Fed has, some extraordinary lending powers And typically in normal times, it sort of operates by lending money or taking money away, borrowing money back from the financial sector, from banks. That's by design. That was sort of back to the nearly century plus origins of the Federal Reserve. But in times of extreme panic, exigent circumstances, the Fed can lend money much more directly to the public and private sector, to corporations, to municipalities, state and local governments. It is supposed to lend money with the expectation that it will get it back. So it is not looking to take losses. The Fed is now looking to lend money to small, medium, large corporations, the private sector. It's trying to roll out a municipal lending facility. So it is acting as really the banker to all public and private borrowers in the United States.
We'll get back to more of our interview with Mark Spindel in just a minute. Hey, during the break, why don't you sign up for our free weekly newsletter? Just go to jillonmoney.com. That's our website. And there, it's very easy. Throw in a little info, your email address, we'll send it to you. Okay, we'll be right back.
Welcome back to Jill on Money, where Jill Schlesinger takes the mystery out of your finances.
You're back. It's Jill on Money. And this hour, we're kind of talking about the big picture economy. What's going on? How do we look at the actions that the Federal Reserve and the government have taken? And for that, I have a special guest. His name is Mark Spindel. He actually wrote a book about the Federal Reserve. He co-wrote it rather, The Myth of Independence, How Congress Governs the Federal Reserve. So before we went to the break, I asked Mark how he gave, what grade he would give to Jerome Powell, the chairman of the Fed, and the Federal Reserve actions that have been taken. And he said he'd give him a B. Okay, a B, but a B is not an A. So I was wondering what exactly it might take to bring the Federal Reserve up a grade. What kind of grade inflation could we see? So here is more of our interview with Mark Spindel. And if you got a question, of course, don't hesitate to send us a note. It's askjill@jillonmoney.com. So a solid B, what would have given them an A in your mind? What could the Fed have done to give an A?
So, one question is, was there an A to get? They really went significantly lower in the credit spectrum, lending to borrowers that are deemed in markets as high yield or junk issuers of credit. They haven't bought a lot of high yield bonds, but they have bought some. And I think it begs the question that really all throughout the last decade, kind of post-financial crisis, the Fed has talked about the level of borrowing in the private corporate sector as being too high. And we see this in a lot of their metrics. The Fed, as a result of laws after the financial crisis, releases a financial stability report. And in all of those reports, they've talked about the corporate sector as just being overly leveraged, borrowing too much. But I think it does set up the possibility that investors and borrowers will always feel that Jay Powell or the Federal Reserve has their back. And I think that can lead to some unhealthy decisions by borrowers to take on too much credit.
If you're warning about this thing and then you turn around and you actually say, okay, I warned you guys, but you don't let that industry just sort of implode on itself or make the people take the losses after taking those undue risks, then you're really like, what was your message to begin with? What was the point?
And I think that's why I can't see a grade higher than the B I've given them, because it just seems at odds with everything they've talked about in the more speculative sector of the bond market or the credit markets.
Okay, let's move to the idea of negative interest rates. In some European nations, they have what's called negative interest rates. So number one, can you explain how that works? Like someone sent us an email and said, so wait a minute, I pay the bank to hold my money? What actually happens when a central bank of a country makes interest rates go negative? What's happening there, Mark?
So let me confess, Jill, I find it really hard as well to get my head around what a negative interest rate really entails. As you propose the question, what does it mean for the bank to put a negative interest rate on my deposit? The first thing that I would think about is, why would I want to keep my money in the bank if the bank is going to charge me for that service?
The only way I figured that like when it makes sense is that you're in a banana republic where you think that the state is going to come in and take your money. So if I'm in, I'm going to make this up. I'm in like some crazy period. It's Latin America, or maybe I'm Brazilian. I'm really scared of this maniac in charge. You know what I'll do? I'm going to put my money in this Swiss bank. I'm going to pay the bank to hold my money because I'm so scared that the state is going to somehow figure out how to grab my money otherwise. So that's the only time I think, okay, that's possible. Or maybe in a short-term basis, like I would pay someone to hold my money as long as I could guarantee that the money would be there. Like a few pennies, just so I don't lose anything if the entire world was falling apart. What are the other instances where we think you would actually pay to keep that money in the bank?
Well, one thing that the central bank or that negative interest rates are trying to stimulate is maybe you won't keep your money in the bank. And maybe you'll say that there's now this additional cost, this fee, this negative interest rate that I would have to pay. I better go out and spend that money or invest that money because there's something else that is going to give me a higher return. When we think of it that way, that's the primary motive for central banks to entertain what you and I agree is this sort of weird idea that interest rates can be negative. We think of the world in a nominal space, that if interest rates are negative, it's going to be costing me something. But economists also think of the world in real terms, that there is inflation, and it could very easily be the case that even interest rates at zero, if inflation is running at 1 or 2%, there is a real negative interest rate that you're losing the purchasing value of that dollar by 1 or 2 pennies every year. And so in real space, we've had interest rates and continue to have interest rates that are below zero. I think the point of moving interest rates in a nominal world to negative is really to get investors, savers, consumers, households to spend money and not keep it in the bank. So in a way, the weirdness that we're describing is by design. They don't want you keeping that money in the bank.
Right.
They want you investing it and spending it.
Okay, then last question for you. Will the Federal Reserve, as it is currently constituted, move to negative interest rates, in your opinion? Because you are an expert, you did write a book about the Federal Reserve. Do you think that that's a possibility, a probability? What do you think?
I think there's a low chance that this Federal Reserve, even in this environment, has any plans to move interest rates below zero. One of the things that we've just discussed is that it will put enormous pressure on banks. And I think the structure of the Fed, the political design, sort of keeps the Federal Reserve and our financial sector really trying to work in concert. And we don't seem at this moment, and more importantly, Jay Powell, the chair of the Federal Reserve Board, has told us that is not one of the tools that they plan to roll out or use.
Okay, during the break, here's what you should do. You should go to the website, jillonmoney.com. Just do that. And there you can also check out our sister broadcast. It is called the Jill on Money podcast. It's daily, and you can get it on Apple or Stitcher or Spotify, radio.com, Google Play, anywhere you find your favorite podcasts. We've got lots of information about the podcast. Just hit the listen tab at jillonmoney.com. We'll be right back.
If you've missed any part of the show or want to check out a past show, go to jillonmoney.com for more great personal finance content.
You're back. It's Jill on Money. We are talking to my high school friend, Mark Spindel. He is the founder of Potomac River Capital. He's been managing money for quite some time. He's also the co-author of The Myth of Independence: How Congress Governs the Federal Reserve. And, I've been thinking about this. I'm sure that you guys have, that every time the Fed chair gets up and talks, he says, we've got additional tools in our toolbox. What exactly could the Fed do if things start to soften even more in the economy? What if we have kind of this W shaped recovery where we go down, we bounce back up? What if things get worse? What more could the Federal Reserve do? That's what I asked Mark Spindel. Here's the conclusion of our interview. Okay, before we let you go, Mark, what are other things the Fed could do if for some reason the economy sputters? Yesterday, you told us that the hole in the economy may be shallower than we think, but let's look ahead. Let's just say that things really do stagnate. What else could the Federal Reserve do? What is in its arsenal that it would be likely to do if things do stagnate from here?
The tools they have now are not great tools, but they could continue to use them a little more aggressively. So they could continue to buy, if not ramp up, their willingness to lend money to the U.S. government. They could move to more aggressively purchase U.S. government bonds. The equity market has rallied so sharply over the last couple of months. We've seen an uptick in yields of risk-free investments, U.S. government bonds. The Fed could try to tamp down on that rise and increase their purchases there. They could promise to keep interest rates low for even longer than we expect. We know interest rates are zero. They're going to continue to promise to keep rates low, but they could make that promise even louder and bind themselves to guiding interest rates even lower. That could make it easier for the government to borrow, to issue debt. They could use the government could then use that money for additional fiscal policy tools. So I wouldn't say that the Fed is out of ammunition to fight another slowdown or a continued soft economy. But none of these tools are great. And as we were discussing with negative interest rates, there could be some unintended consequences of a larger balance sheet, of compelling the federal government to borrow more, or just to keep interest rates low for even longer.
Okay, thanks again to Mark Spindel of Potomac River Capital. His book, which is massive, by the way, it's called The Myth of Independence: How Congress Governs the Federal Reserve. Let's do a quick question here before we get to the end of this break. This is from Joel. And the subject, which is perfect question coming out of this interview, which is about the impact of $3.8 trillion deficit. So here's the message from Joel. First of all, my wife and I very much enjoy listening to your daily podcasts and on our now daily neighborhood coronavirus walks. Question: since nothing is free and we have a law of cause and effect, what will the impact of the estimated unprecedented $3.8 trillion deficit this year and another huge deficit next year? When our government prints money like it's doing, how could it impact us in years to come? Could this lead to inflation sometime in the future? I'm within 1 or 2 years of retirement. Okay, so let me start with that before I do his other question. The answer is, over the long term, deficits can create inflation. They can also create some economic stagnation. The probably more immediate issue is that before that happens, chances are that there will be a change in tax policy. And that's what I'm kind of planning for. I'm saying to myself that with big, huge debt and deficit numbers, my guess is that we are likely to see the tax rates that we're paying right now rise. And that shouldn't surprise any of us. We're at pretty low levels, but I would think that this makes this almost a foregone conclusion. Okay. So that's number one. Number two, let's see, your other question. I have a 60-40 split of stocks to bond and cash, and we're comfortable with that. We're doing three things: rebalancing when it gets out of balance by 5% or more. That was done on March 15th. Switching my 401k to contribute 100% to stock for this uncertain period, while also buying $3,300 in Vanguard Index Total Market. Every time the S&P drops by 5% or more, I buy $1,000 times the percent drop in the Vanguard Index. Total 32 grand to date. That's kind of wild. The cash I use is extra above my rainy day fund, which contains $150,000. While everyone is panicking, I feel like these dollar cost averaging steps and purchasing are forcing me to maintain my plan and taking advantage of a sale in stocks. What is your opinion of my strategies? Well, look, I think the rebalancing is fine. You're doing some market timing. And so that the S&P dropping by 5% or more, that might work out fine for you. It might not. I don't think I would just buy the S&P 500. If anything, what I would just do is take a certain amount of money over and above my rainy day fund and put that to work. And I'm not sure that I would actually change it as you are doing it right now. So that's what I would do. I would try to maintain whatever allocation I have already. But it sounds like you have done a fantastic job. Okay, that is it for this segment. We got time for one more little quick segment before we finish up for the day. It's Jill on Money. Do me a favor, hop onto the website. Why don't you buy my book, The Dumb Things Smart People Do With Their Money, 13 Ways to Right Your Financial Wrongs. We'll be right back. You're back. It's Jill on Money, where we are broadcasting from the Policy Genius virtual studios. Policy Genius is the easy way to compare and buy insurance. Just go to policygenius.com and you can get more information there. Let's do one last email before we close out the program. This is from Joseph, who says, "Hello, Jill. Been enjoying your thoughtful responses for some time, and I find them to make things clear. I hear a lot about using index funds and their ease of use in managing one's money. Some years ago, I inherited 2 investment accounts with a lot of stocks and bonds, one taxable and one IRA. I have been considering switching out of the stocks and going into index funds to simplify management, though most of the stocks I have provide good dividends. Do you have recommendations about doing this? I do realize the taxable account will benefit in my selling losses against gains to save on taxes." I mean, this is something that could really be helpful just in terms of management. So first of all, we know that inside the IRA, you can do this almost immediately because there is no tax implication. You just want to make sure that your allocation is in line with what your needs are. In terms of the taxable account, you're right. You're just going to make sure that you understand what the tax liability would be, because if you inherited these accounts, you might have inherited a while ago, and now they have a lot of built-in gains. So maybe this is something that you do in 2 stages. Maybe you have a lot of taxes to pay over the course of a couple of years. So it's just something that you want to plan for. I think that if you plan ahead of time, the idea of moving from individual stocks and bonds to index funds can be easier. And if you want, and you want to give us a rundown of what you have, I'm happy to take a look at it just to help you maybe come up with a good strategy. How about that? All right, that's it. That's the show. If you missed any part of this, just go to our website, jillonmoney.com, and click on the listen link, and you will see the show pop up for you. You can also sign up for our free weekly newsletter. We thank you so much for listening. We do really appreciate it every single week. Don't forget, of course, you have to do something very important. Wash the hands, wear your masks, keep that physical distance, do something nice for somebody else, please. Okay, we'll talk to you next week. Thanks for listening.